Personal finance practice problem using Excel. Present value of an annuity using non-annuity Excel functions. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information on the left-hand side, going to populate that into the blue area on the right-hand side. We'll be looking at the present value of an annuity, doing the normal kind of annuity type of calculation, then also breaking it out into its components, into its individual periods, in this case years, and applying the present value of one calculation on a year-by-year basis. Something that you might say, why would I do that? That's somewhat tedious, but it's fairly easy to do in Excel, and it's actually quite common even if you have a nice annuity kind of setup, because then you get the more detail on a year-by-year basis, and also when you're looking at a more complex cash flow situation that you can't break out into a nice standard annuity, then this is the method that you basically have to use. This is often a common method when we think about the present value of an annuity, just to keep a scenario in your mind, is if you're kind of budgeting going forward into multiple periods into the future, and you're trying to think about, should I do one path or another? For example, should I purchase a new piece of equipment or something like that? And you're trying to project into the future what that would result in terms of cash flow streams or returns into the future, that kind of decision-making process. So here's going to be our information. We've got the amount is going to be $1,000. We got the rate 7%, the years at 5 years. We're just going to do this with the Excel functions this time, so we're not going to be using a mathematical calculation, and we're not going to be using the tables. We're going to do what we normally do in practice here, which is going to be an Excel function, and then we'll add some more detail, possibly with a running balance when applicable. So first, we'll just do the normal calculation. We'll do it fairly quickly because we've seen this in the past. The normal annuity calculation, I'm going to say negative to flip the sign, present value, shift 9. The rate is going to be that 7%. I'm going to say comma. We're going to pick up the number of periods, which is going to be 5 periods down here, and then comma, and then it is an annuity, so we're going to be using the payment item. The payment we're going to say is 1,000. We present value that. We're at the 4,500. Obviously, if we were just to add up all the payments, the total cash flow, so cash flow without the present value would simply be equal to the 1,000 times 5, so versus the 5,000. Let's go ahead and make this one black and white, and let's go ahead and make this one. This one will already be there on your Excel worksheet. Okay, so then we might say, well, let's break this out into a one-by-one present value of 1 5 times. And so this hopefully will give you an idea of the interplay between these two things as well, the present value of 1 and the present value of an annuity. Also note and be aware of how we're setting up the table here, because how you set up the table will make these calculations much easier and allow you to do projections and more complex and nuanced projections a lot more easily as well. So we're going to set this up by putting our years over here. I'm going to say 1, 2, selecting those two. Going to put our cursor on the fill handle, drag it on down to 5 periods, or 5 periods. Let's do 5 periods, and we'll center that. Home tab, alignment, and center. Then the payment is simply going to be $1,000 each period. So I'm going to say this equals $1,000. So there we have it. I'm going to say, we could say F4 on the keyboard, expecting that we're going to be copying that down, putting a dollar sign before the B and 3. In other words, making it an absolute reference. And then what we'll do is, let's copy that down first. Here's our series of payments. Let's copy that down. So there's our 5 payments of 1,000. If we total this up, we can put up the total here. This is going to be the sum equals the trustee equals SUM, shift 9, up arrow, holding down shift, up, 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 and enter. And so now what we'll do is we'll just present value of 1, not an annuity. We have our annuity set up and our years set up, and we'll just do a present value of 1 calculation on an individual by individual basis, which is something that we can copy down. So you can see this is fairly easy to set up once you have the table properly put together. So we're going to say this is a negative present value, shift 9. The rate is going to be that 7%. Now we will do this a couple times, but if you were to copy it down, you'd say F4 on the keyboard so that you have an absolute reference there so that you can copy that down and the 7% doesn't move down, comma. We'd have the number of periods. Now here's where the number of periods is now 1, not 5, because we're doing this one at a time. So we're trying to take the one payment that's going to be 1 year out, bring it back to period 0. And I'm going to pick that one up not by typing it in, but having it over here in our formula or in our table. And note how convenient that is, because by not typing it in and using the table, I can then copy this down, and this cell will copy down relatively, so I don't have to deal with reformatting it all the time. And that, again, that makes your table way easier to be copying down. So we'll say comma, and then comma again, because this is not an annuity. Now we're doing the present value of 1, and we'll simply point to that 1,000, and there we have it. So the one payment that's 1 year out is, if I bring it back to time period 0, would be 935 about. Let's do it again. We'll just do it a couple more times, and then we'll go back up and copy it on down using the autofill feature. Negative present value, shift 9. The rate is going to be that 7%. We're going to say comma. Number of periods is going to be this 2, which we're not hard coding or typing, but rather getting from our table, noting how nice it is that I can then copy that down, comma, and then comma, because this is not an annuity but present value of 1. We're basically taking this $1,000, discounting it back 2 periods to period 0 using the discount rate of the 7%. Let's do it again. Negative present value, shift 9. We're going to pick up the rate, 7%, comma. We'll take the number of periods, which is now 3, which I'm going to pick up from this cell instead of hard coding or typing it, comma. No payment, because this is not an annuity, comma. Future value, the 1,000 again, and enter. So we discounted this $1,000 3 years out that we're expecting to get it back 3 years using the discount rate of 7%. Obviously, you're getting a present value, which you get a decrease as we go further out into the future, expecting the cash flows happening further out in the future, which is what you would expect, and also something that gives you a better visual or concept or idea of what's actually happening than you get when you just kind of get the magic number here for 5 years out. So this could give you a lot more context, and again, easy to do really in Excel. So now we're going to say, do it again, present value, shift 9. The rate is going to be then the rate is going to be the 7%, comma, number of periods 4, comma, and then comma, future value 1,000. So we discounted that 1,000 back 4 years now at the 7% to get the 763. Let's go ahead and delete these and do it one more time, this time with the autofill, just to see how easy it is to autofill it down. So we'll say negative present value, shift 9, rate is that 7%. I'm going to make sure to hit F4 on the keyboard this time, making it absolute $ before the B and 4. That means it's not going to move when I copy it down. Comma, number of periods is going to be that 1. This one, I do want to copy it down, and that's why I structured the table to have the years in a column format like this in a cell reference that I can easily reference just the year. If I put something like year 1 in this cell, I can't reference it because it's not a number anymore. But if I put a 1 there, I can reference this and copy it down. Then comma, comma, future values that 1,000. We want that to move down as we copy it down. So we're going to say OK. And then we're just going to do our autofill feature, putting our cursor on the autofill, dragging it on down. I'll double check the last one by double clicking on it to see if it does indeed do what we want. The rate's picking up at the 7%. We've got the payment, which is picking up here. And we've got the future value. This is the number of periods picking up here. Future value. It looks like it's doing what we want. Now we can just simply sum it up equals the SUM. Up, holding down shift, up, 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 and enter. That's going to give us our 4,100 matching out here. Let's put an underline just to make it look a little nicer. Font group and underline. So there we have it. Now, like I say, before you had Excel, you would try to avoid this kind of calculation whenever possible. And when you're working with book problems, you're going to avoid it because calculating 5 separate present value calculations is tedious and you don't want to do it. But if you're using Excel, you can see how easy it is to do and how much more flexibility you have to do that. And it actually gives you, even with you have a normal common calculation for an annuity, it gives you more detail that you're going to want to have. So it's often useful to kind of do that even in a standard annuity. And when you have more complex cash flows, if you're doing something and making projections into the future that you're going to have uneven cash flows in some way, then you basically have to do this. If you're trying to project or budget into the future and you're imagining what would happen if my revenue goes up by 5% each year or something like that. Well, now you've got an uneven cash flow into the future and whatnot if you're going to present value that and try to compare it to some other option where you think revenue is going to grow differently, but for a longer time frame and that kind of thing. So we can also set this table up to, I like to see it this way. This is how I tend to set it up. But a lot of times when you do budgets and whatnot, you'll end up with a budget on this kind of horizontal fashion. And then you can use your present value table function in this format as well. So in other words, let's hide some cells and look at that. We're going to put our cursor on column C, drag on over to column I, let go, right click the selected area and hide. Don't delete it, just hide it. And then we're gonna do this again. This time we'll just do the same thing, but now the years are on top here. So we got our years broken out. And the reason this is helpful is if you do like an income statement, you'd have income and expenses that list out here by year possibly. And then you can have a complex series of cash flows for inflows and outflows for like an income statement. And then you can get your bottom line cash flow. And then you can simply apply out your present value to try to discount everything back to the current time period using your discount rate here. So let's try that out. So we're gonna say the payments. This is gonna be the payments now. Just gonna be that 1,000. So this is gonna be equal to the 1,000. I'm gonna say F4 on the keyboard to put a $sign before the B and 3. And then we can just add that across. We can say, let's bring those payments across for the 5 payments. That, of course, adds up to the 5,000 that we're expecting to happen in our annuity. Let's do the trusty SUM to say there's our 5,000. Then we can have our present value calculation, same kind of concept, except now we just got a little bit different format of the table. So, and it's useful to be able to see these tables in your mind to start to build them. What do I want? What do I want on the X and Y axis and whatnot? The better you can visualize those, the easier it makes things. It's basic stuff. It's nothing difficult, but it is difficult in that, until you start visualizing, it's kind of hard to see how you want to set your table up. So in any case, this is going to be the present value, shift 9. Let's make it a negative. Present value, shift 9. The rate is going to be that 7%. Once again, we can make an F4 or absolute reference to copy it across, although we will first do this a couple times before we do copy it across, comma, number of periods. Now they're up top here, 1 period out. So we got 1 period out. Notice that we do have each of these headings as just one number, because if there's anything other than a number in it, I can't reference to it. I have to then hard code the number in my formula, and then it doesn't copy across easily. So just be aware of that. Makes the table a lot easier if you can copy it across. And then comma and comma, future value is going to be that 1,000 right above there, and enter. So there we have it. Let's do it a couple more times. Negative, present value, shift 9, rate 7%, comma, number of periods is now 2, which I'm picking up from the table up top, comma, comma, because it's not an annuity, but present value of 1. Future value is the 1,000. So we discounted back that 1,000 now 2 years at the discount rate 7%. Do it one more time and then we'll do the autofill. Negative present value, shift 9. Rate is going to be that 7%, comma. Number of periods is now 3, which I'm picking up from the top column of the table, comma, comma, because it's not an annuity, but present value of 1. Picking up the future value, which is the 1,000, and enter. And so on. Let's go ahead and then do this for the whole thing here. Let's delete these and do it one more time, being mindful of what we need to do to copy it across, including things like absolute references. So we'll say negative present value, shift 9, rate 7%. That's outside the table, so I'm going to make an absolute reference by selecting F4 on the keyboard, putting a $sign before the B and 4. You only need a mixed reference, by the way, but an absolute reference is easy to think about. Comma. Number of periods is now that 1. I don't need an absolute reference here because I want that to move to the right as we copy the cells to the right, comma. It's not a payment because it's not an annuity, comma. The future value is the one above it. I don't want an absolute reference here either because I'm going to copy it across. Also note that if this was a basic table, you might just get this number from the reference to the right, which is the 1,000, and make it absolute. But if you had a more complex series of payments, then of course you'd want the payments, your to be listed up top, so it's more common to this format. And then we're going to copy it across, put our cursor on the autofill handle, and drag it on down. Drag it on down to 5 periods. Then we can sum this up equals the SUM of these items. And there we have that 4,100 once again. So let's unhide some cells. We're going to go put our cursor on column B, drag on over to K, let go, right click on those cells and unhide those cells. And we can see those in a few different ways here. Now look, now again, just note that this kind of format to set this up, like I said, you won't see it in textbook problems as much because they're trying to focus in on what you might be able to do with tables and formulas and on a test setting when they take away Excel. But when you have Excel, you can see how much more flexibility this leads you to. I mean, you can come up with much more complex scenarios on what you think is going to be a future cash flow and not be restricted. If you're restricted to something like this, then you start coming up with future cash flow scenarios that are too even. You like got too much perfection in your, and if you're able to easily set up a worksheet like this, which is quite easy to do, you can start to brainstorm in cash flow scenarios that are going to happen in the future that are more complex and possibly more closer to real life, and then actually, be able to have more predictions and whatnot of what's going to go on. Obviously, once you set the table up too, you can change any of your data here to like 8% and whatnot, and that'll change everything in your scenario as well. And you want to kind of practice setting up your Excel worksheets like that so that you can run different scenarios.